to be sure you're getting the most out of your retirement for all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now here's Jim with this week's Dollars and Cents tip.
Let's talk about estate tax and the fiscal cliff. As you know, the Bush tax cuts were extended for people making joint filers less than $450,000 and under, and then for other filers $400,000 and under. Now, by the way, the Medicare surtax in the new healthcare plan, or the healthcare surtax, still is at $250,000 and $200,000. That's that 3.8 surtax, which is a surtax on investment income. If you're over those amounts, so be aware of that. That will affect your capital gains and dividend tax. Will basically go from 15 to 18.8, even if you're between that 250 and 450 number, or 200 and 400. But let's talk about the estate tax. The estate tax was set at $5.25 million. It's actually the original $5 million from 2011, but it's indexed for inflation. So this year it's $5.25 million. Okay. And maybe more important, or just as important, is the portability of the estate tax exemption between married couples. See, estate tax planning 101 in the past, if the estate tax was $5 million, to use a round number, if you didn't use your $5 million and you left everything to your spouse as opposed to your kids or to a trust for your family, then you didn't use your $5 million, and you didn't get to extend it to your spouse. It wasn't portable. They've now changed. They changed that in 2011, and they have extended that as well. So what that means is a married couple, without any kind of estate tax planning, automatically in 2013 gets $10.5 million without any estate tax planning. Okay, that's very significant. The rate of anything over that 5.25, or for a married couple, 10.5 million, is 40%. We still have step up in cost basis, meaning if you own a piece of property or a stock and it's highly appreciated, let's say you bought a property for $200,000, or say for $100,000, it's worth $400. The capital gains tax exposure goes away at death. That's called a step up in the cost basis. The cost basis, of course, is what you've already paid the tax on. So the estate tax thing, that's a big deal. Now, it is a permanent fix. In other words, there's not a sunset provision where it expires at some point in the future, where we deal with this mess all over again. It's the first time we've had certainty in estate tax planning since 2001. However, I will qualify. Laws can always be changed. And as we move forward with our budget problems, this could always be something that comes back onto the table. But for now, we've got a permanent law that we can plan for.
The views expressed, and that's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.